I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is March 15th.
And today we'll be going over where interest rates are and some of the things happening in the marketplace that are affecting those interest rates.
This is for informational purposes only. This is not financial advice. And if you like what we're doing here, be sure to subscribe, comment, and like. And if you do have any comments or scenarios, be sure to, when you do that, know that we're going to get back to you right away. We do like to reply as soon as possible.
Yeah, every once in a while people will call and say, hey, is this Tom or Eddie? Yep, this is Tom or Eddie.
Right. And, if you've been out there in this last week and you've been listening to the radio, news, podcast, you're going to obviously be very aware that banks have been failing. Several banks, 3 in particular, have actually had a lot of trouble, and the Fed has gone in and propped them up. And I think the big takeaway that Tom and I want to address is that these banks were giving risky loans or making risky bets at bad times. Mm-hmm. Some of them were exposed to the crypto markets. Others were buying bonds.
Yeah, they actually bought some of the most secure investments, in the world, which are still secure. But at the time that they bought them, interest rates were so low that in this high interest rate market, they became not as valuable.
Yeah, that was Silicon Valley Bank. That's the biggest bank that really had all the issues starting on Friday, the 10th. But I think, people are wondering, is this going to happen to all the other banks? There is a lot of uncertainties about what's going to happen with banks. I think that there probably are other banks with risky assets.
Yeah.
But the bottom line is that the government, at least the FDIC, has come in and said, listen, we're going to actually override. Even though the bank depositors are insured for $250,000, there's an override that went above that. I don't know if there is an actual limit. They're guaranteeing the withdrawal for depositors.
Yeah. And so basically there's 2 sides to this. There's a technical side, which is if you were to open up, these banks, you'd see, some banks that probably are having issues. But the practical side of this is it's up to regulators, it's up to the feds, it's up to the administration to give Americans, that hope and that confidence that we're going to be okay. I mean, if anything happens to our banks, that's a really big thing. So don't walk away from this podcast saying, oh my gosh, something else is going to be falling. Things may happen, but they've been happening for years and years. We're just simply making the announcement that, yes, you've all read in the news that there have been a couple of bank failures.
Yeah, that's right. And Tom and I have been talking about, we try to say this in the best way possible. For mortgage interest rates, that's why you're watching the video right now. You want to know what's going to happen with mortgage rates. In many ways, bad news in the economy is good for mortgage rates. And this is actually a good thing for mortgage rates. Mortgage rates will have come down. And the reason is because the government, because there's signals out there that there's cracks in the system.
Yeah, and what the feds are doing is the feds are waiting to hear cracks. Once they hear these cracks, they'll say, okay, we don't need to raise interest rates as much. But if everyone's singing and everyone's just carrying on, they're going to keep raising those interest rates. So that's why what we're saying today kind of makes sense, even though it's kind of weird. Bad news is turning into good news.
Yes. So from this is where we do see that the Fed is basically signaling this could be the end of the hikes very soon, the Fed rate hikes.
Yep.
And we want to cover 2 big events. One was March 10th. That was Friday. The unemployment number came in 50% stronger than they were forecasting. They were forecasting 210,000 jobs.
Yeah. And remember, we were talking about cracks, saying that we've got more jobs, 50% more jobs. That's not exactly a crack. That's more of a sing.
Yes.
So that's why we were talking about these things. It is higher than what the market thought.
So, right. So the payroll numbers come out and it shows strength in the economy. The banks failing is showing weakness. And there are these conflicting signals. But let's move on to inflation, which is that was yesterday, March 14th. The expectation was 6.1%. That was the forecast. Came in at 6%.
Which is good news. So it is a little bit lower than what we were forecasting. It's obviously not as low as they want it, but it's showing that it's coming down a little.
That's the February. It's released March 14th, but that's showing the February year over year inflation.
Yep. February 2023 to February 2022.
And then so the January inflation number came in at 6.4. So we've gone from 6.4 to 6.0. Right direction with inflation. And I wanted to show you the core inflation that is without food or energy in that equation is at 5.5. So inflation is showing good news because the lower inflation goes, better it is for mortgage rates. 10-year yield. We've been showing this for a long time now. Again, takeaway is Well, 1 week ago, we were right up here on the top. If you can kind of see my cursor, that rates had risen about 20% from February 3rd, gone all the way up. And then the cracks started showing up. And really, that was the banks. When the banks started showing problems, we started seeing the bond yields go way down, which is good for interest rates. And we have seen an 11% decrease in the 10-year bond in 5 days.
Yeah. Yeah, that's big.
And again, we'll continue to track it, but this is all good for mortgage rates. And now all of the attentions, like the next big event is going to be March 22nd in a couple weeks, where the Fed, Jerome Powell, is going to be speaking.
Yeah, are they going to be raising interest rates? You know, again, that Fed funds rate, not the mortgage rate, but the Fed funds rate, they're going to raise it by 0.25 or by 0.5.
So I try to make this is the meeting's probability chart. And I really, really like this chart, and I don't want to overcomplicate it. But you see these columns, this column right here. These are the betting chances, right? This is the CME group, Chicago, that says, these are like some of the best traders in the world that say there's a 26% chance that on March 22nd, the Fed will do nothing.
Right.
There's a 73% chance that the Fed will raise a quarter. And there's a 0% chance, according to them, that the Fed will raise 0.5%.
And just a couple of weeks ago, that was close to 50-50 almost, or even actually a little bit more towards the side of the 50 basis point increase. So look how quick that can change.
And yeah, so this all has changed in the last couple of days. And so what we're also noticing is that I put this yellow highlight here for July 26th, that meeting there, you'll notice that's kind of a pivot. You start noticing, okay, things start pivoting right around July, where we could see rates actually decrease. There's a 20% chance that the Fed rate in July will be 0.25% lower.
Yeah. So look out. This matrix is going all the way out to next summer. So this is a crystal ball of sorts, basically saying, where are we now? Where are we projecting to be? And literally going out into the future, 15 months or so. So we are seeing this push for a decline. Will it happen? We don't know. So this is just a forecast.
Yeah. And I'm just going to show everyone here. If you look at the very bottom, it's July 2024. If you look at this column, there's a 15% chance that the Fed rate will be in this column right here, which is 1.25% lower. So anyway, these things are very important to watch. And I don't know if we have anything more to say on the slide, but
no, I love this slide. Yeah. It's a great, crystal ball look. Are they correct? I guess a crystal ball would have to be right. So this is not a crystal ball, but this is an awesome chart.
All right. So where are mortgage rates today? Okay. So they're lower than they were last week. Now, you can see the 30-year fix is at 6.5% today. Last week was 6.875. The 15-year fix today we see at 5.99.
The 30-year FHA 6.125. The 30-year VA 6.125.
These quotes come with no points, no extra fees, and they're based off of these loan assumptions for conventional FHA and VA loans. Quick disclaimer too, Tom and I, we're mortgage brokers. We're licensed in the state of Arizona. We're only licensed here in Arizona. And so when we have customers looking for a refinance or purchase, and you have a scenario like that, a 6.5% rate would come with 0 points.
Yep.
Typically. Now again, every situation is a little bit different, but
yep. And we can offer lower rates too with those points. We're just showing you how good our rates are without any points.
And a lot of banks, if they're going to be offering a 6.5 today, they're going to be showing you that with a bunch of points or a lot of extra fees. Now, it depends on how they actually break it up, but a lot of extra fees. So be careful of that. And if you have any comments on a scenario that you want us to answer, you want to contact Tom or I, be sure to put it in the comments, or you could email us as well, which is right here on the screen. And remember to subscribe and like the video as well.
Okay. Also, feel free to give us a call, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.